if we get this kind of proverbial soft landing, maybe we get a little bit more inflation, and the Fed can bring rates down to neutral without igniting a whole lot of price inflation, Bitcoin stands to do even better in the near term. So I don't usually throw out price targets, but I do think Q1 2025, probably right around the time that Bitcoin, blasts through 100K.
Start mining Bitcoin today at marketplace.blockwaresolutions.com.
All right, Joe. So the Federal Reserve cut rates yesterday for the first time in over 4 years. And there was a lot of back and forth about whether or not it would be 25 basis points or 50. They ended up going with 50. What do you make of all this?
Yeah, so for a while it was estimated that the Fed going 50 would be perceived as a move that was only aggressive because the economy was weakening faster than expected. But if you actually look at the underlying data, the data that we have been receiving for the last about 8 weeks now, um, a lot of the underlying labor market data that the Fed has been making decisions on is actually stronger than expected. Today's initial jobless claims data came in at 1.83 million continuing jobless claims, down from 1.85 million continuing jobless claims last month, and it was expected to stay at the exact same level. And so essentially what we're seeing is the labor market isn't really deteriorating as fast as many thought that it would. And so this 50 basis point cut, rather than being perceived as bearish because the economy is worsening faster than expected and the Fed really has to kind of make up for lost time with rate cuts, the market is actually perceiving it as bullish. And they're perceiving it as bullish for good reason. Because every single time the Fed has cut, slashed interest rates, slashed the policy rate outside of recession, it has been bullish for risk assets, and rightfully so. There are two different kinds of rate cuts, and we've kind of talked about this before. There are reactionary rate cuts. These are rate cuts that occur when a recession is already happening. So you kind of see how inconsistent and sporadic, and like they started with 50, then did 225, and then they cut by like 100 basis points, and then they did a 50, and then a 25, and then
hmm
this is just all over the map because these are cuts that are occurring in recession. There's a lot of uncertainty that happens when the Fed is doing this, and as a result, you see the S&P 500 tanked over the course of the Fed's rate cuts 54.5%, versus the last time Jerome Powell did what he's doing now, which is cutting rates in anticipation of a recession. And the S&P 500 rallied 12.4% in just 6 months. That's the exact same dynamic we're seeing now. We are not in recession yet. And so essentially, rate cuts to avoid recession are bullish. Rate cuts while you are already in recession and you're reacting to it are bearish, right? And so essentially, what we're seeing right now is bullishness as a function of why the Fed is cutting rates. For a little bit, I was thinking that this 50 basis points would be perceived negatively by the market, but it has not been whatsoever because, again, underlying labor market data that the Fed has talked about making its decisions based on is actually much stronger than expected. And so that's essentially how I perceive all of this. I think it's going to be an excellent Q4 and an excellent Q1 for Bitcoin. Again, the main question is, can we avoid recession? So far, we are avoiding recession. Data that would point to a deterioration in the labor market is slowing down, which is what the Fed wants. And so, really, I think it's going to be a slow and steady move lower in policy rates, which means lower outright real yields, which means easier financing conditions for businesses and consumers. And obviously, that makes for an extremely good market for risk assets. So that's kind of how I perceived what happened yesterday and what we get over the next several months, ceteris paribus, if the labor market can stay intact.
That's really well said. Would this, let's say hypothetically, we were on the trajectory towards a recession, would this actually do anything to stop it? Because I know the sort of effects of changing monetary policy take time before they manifest into the market. So, doing a 50 bip cut versus a 25 bip cut, would that actually change anything if we were going towards a recession?
No, not immediately. Part of it is the perception around the Fed cutting interest rates, and so, but you're exactly right. Like it takes about a year for any of this to really transmit into easier financing for businesses and consumers, and actually loosening financial conditions. The fact that the Fed thinks it can influence the economy by moving policy rates is pretty flawed because they know that it takes a year for the effects to actually take hold in the economy. So it wouldn't make a massive difference if we were like if a recession was imminent. But we do know that the Fed has created other means by which they can stimulate the economy. They really they created an emergency facility overnight for banks that were feeling the heat during March 2023, and really did save a great deal of the banking system overnight.
Mhm.
And so we saw what they did with quantitative easing following 2008 and what happened there. These large scale asset purchases to immediately imbue banks with liquidity onto their balance sheets. It can do those things. It can do these asset purchases, huge asset purchases overnight, out of thin air for these banks. And so I don't think that the rate cuts would have made much of a difference if we were heading into a recession, because the U.S. Treasury market is really in control, and now that there are really no reserve requirements at banks, influencing financial conditions by just using the policy rate isn't very effective. And so the Fed's main tools now are other policy rates. But Yeah, no, I don't think it would have done anything if we were immediately heading into a recession. But if we were, the Fed has other tools that it could use to help imbue the banks with liquidity and stimulate the economy.
Gotcha. Yeah, you and Nick at the Bitcoin layer, you guys say that a lot about the treasury market being in control and the Fed policy following the treasury market. And I could really see that playing out over the last couple weeks because it was basically set in stone. Hey, they're doing 25, they're doing 25. And then over the last week or so, yields just dropped. And it's clear that the Fed was reactive to that and went 50 because I'm sure before that they were going to do 25.
Yeah, absolutely. Basically, what had happened was there was a series of economic data prints over the last several weeks. Um, but then also, more importantly, there was so what the Fed does something called trial balloons. Basically, what they do is they put out a feeler for how a certain monetary policy move is going to go in the market. And the way that they've been doing this as of recently is through Nick Timmerhouse of the Wall Street Journal. They basically tell Nick Timmerhouse exactly what's going to happen, and then Nick Timmerhouse, the week prior to the Fed's rate cut, usually like the Friday of or even the Monday of the Fed's rate cut, that following Wednesday, he releases an article basically saying exactly what the Fed's going to do, and kind of hinting at it, strongly hinting at exactly what the Fed's going to do in order to kind of prime the market and get it ready. It's called forward guidance. One of the reasons the Fed has been able to manage this cycle so well is because it tells the market exactly what it's going to do beforehand. So the market, there's no uncertainty baked in. There's a high degree of certainty. But last week, the leak from Nick Timmerhouse didn't provide any certainty whatsoever. It basically moved odds from like 80% that we get a smaller rate cut, 20% that we get a larger one, to basically 50-50. And then over the last week, we've had several more major financial pundits pointing toward 50. We had Anna Wong of Bloomberg pointing to 50 on the morning of the Fed's 50 basis point rate cut. And so it was the most uncertain that the market has ever been heading into an FOMC. And as a result, the price action that you saw yesterday, the S&P 500 ended in the red. That was mostly a result of algorithmic hedge funds unwinding their positions because they were offsides. There was only one bank that said we were going to get a 50 basis point rate cut. Every other bank and all of the funds working for or adjacent to the bank or using the bank's research were positioned for 25. And so the reason we ended in the red yesterday was because all of these traders had to unwind their positions. But now you're seeing the real way that the market is reacting to this 50 basis point rate cut, which is green, green, green all across the board. We have the NASDAQ up 3%, S&P 500 up 1.8%, and Bitcoin up 5.5%, the king of them all, the king of the risk bucket, if you will. So clearly the market's reaction to this 50 basis point rate cut is very bullish, but we'll have to see how the price action evolves over the next 3 weeks, because following the Fed's 50 basis point rate cut in 2007, the S&P 500 rallied for 3 weeks. Stocks rallied for 3 weeks. Everyone thought that, it was all hunky dory. But
Mhm.
then things started to slide and go sideways. And then the Fed needed to do even more cuts and more aggressive cuts eventually. So we'll see what happens. We'll see what happens. For now, it looks like the market is perceiving it bullishly. If labor market data can remain intact and underlying financial plumbing can remain intact, then I think the path of least resistance for all risk assets, Bitcoin most of all, is higher, much higher.
Yeah. Let's sit on this idea of certainty versus uncertainty for a minute because this is one of the main things I was thinking about yesterday as everybody on FinTwit and Bitcoin Twitter is going back and forth on the rate cuts. It really just highlights the one of the key value propositions of Bitcoin, which is we know for certain what the monetary policy is today. We know that it's going to be next week, next year, 1,000 years from now, versus fiat. We're literally sitting there 30 minutes before they make a policy decision trying to figure this out. And
Mm.
on that point, kind of a key moment of uncertainty, just not only in markets, but within culture, is the election that's coming up in about 2 months. And funnily enough, we actually don't have another Fed meeting until the day after the election. Do you think there's some uncertainty around the election and maybe that might be having an impact on markets? How do you expect things to kind of play out with that in mind? And do you think, the outcome going one way or the other will influence the direction of markets in the short term after that?
Mm. Yeah, so I'll take the first question first. I do believe there is a huge degree of uncertainty surrounding what's going to happen in the election, and that's priced into markets, right? Like, information travels fast. Markets know that, okay, it's a 50-50 toss up. They're kind of hedging their bets between Kamala and Trump, but for two different reasons. Businesses stand to do very well, and equities and other risk assets stand to rip under both of them. Reason being, we're going to have a deficit either way for both of these people, right? It's no doubt that if we get Kamala, that deficit will widen out much more dramatically. We currently have like a 6 or 5.5% deficit as a percentage of GDP, probably widen back out to 8% over her presidential term, if not even more. That would be my prediction. So as a result of that, all that government spending money into the private sector, that's very good for businesses. It's very good for risk. And so, I think under Kamala, you would see a deficit that gets wider faster. And as a result, businesses and risk assets would do well. On the flip side, well, we'd get a crap ton of inflation, but, businesses and growth would be supported. On the flip side, if we got Trump, businesses would do well for a different reason. We'd get huge, wide sweeping tax cuts, which
Hmm.
is very good. Also, we would see a market decline in the income tax, and a lot of that would get replaced with tariffs, which is what he has talked about. Rather than taxing everything into oblivion, massive sales taxes, massive property taxes, massive income taxes. He has discussed eliminating a lot of those in the interest of replacing it with tariffs, which is something that we've done before in the United States, which would be a wholesale change to the way that we pay for things and we actually finance our government. But what it would lead to, chances are, obviously, it would lead to an increase in the price of goods and services, but it would lead to a market decrease in the amount of taxes that are taken out on your income. And so I think over time, people would be not just nominally richer, but richer in real terms, more US dollars in their pocket relative to what they're spending, which means spending gets supported, consumer spending gets supported, and then businesses do well as a function of that. You see growth get supported, and you see risk assets do well as a result. So I think that it's less of a hedging going on in markets. I think it's just cautiousness and trepidation, not because they're afraid of who's going to get elected, but of what might happen in the lead up to the election. We've already seen two assassination attempts on former President Donald Trump. Chances are we may see a third, a fourth, a fifth.
Actually, I think we did. It wasn't mentioned much, but there was a third. Like they found like a bomb in his car nearby his rally the other day, like 2 days ago or something like that.
Unbelievable. Of course they did. And so
Yeah.
he's now been upgraded by the Secret Service to presidential level security. But even then, it's hard not to believe that there's some kind of coordinated effort in order to get Donald Trump out of the picture, which is a terrible thing to say. But I think if you're seeing this happen twice under the watch of the Secret Service, the first of which as well was completely unbelievable, like given the fact that it was recorded on so many different angles, we have so much information about it, and it's basically been swept under the rug. That heavily suggests to me, right, if you have any kind of skeptical mind, that this was some sort of an inside job. Either way, I do think that markets may be hedging themselves due to geopolitical uncertainty rather than uncertainty about what the economic policies of each candidate will do for the economy, if that makes sense. I think any hedging that's going on in markets, any trepidation about diving headlong into risk assets, is probably to do with geopolitical uncertainty, due to whichever candidate will get in, more so than it is like the differences in economic policy between the two candidates. Because I think either way, for very different reasons, Kamala is being much, 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 much more inflationary than Trump's. Both businesses and consumers tend to do well under either presidency. Obviously, you get an insane amount of inflation under the Harris presidency. So I hope we don't get that, but we'll see.
Yeah. Well, the TLDR I got out of that is no matter which candidate gets elected, it's going to be bullish for risk assets for
Mhm.
in either scenario. So that gets me very excited. You've been sort of like, dare I say, religiously following the twos and Fed funds yield curve, and I remember
Mhm.
you talking about this all the way back in 2022. And according to one of your recent tweets, this metric is telling us that the market expects roughly 200 basis points worth of cuts over the next year. What effect will this have on net liquidity, the Bitcoin price, and the market overall?
Extremely good question. So here's the two's Fed fund spread. Now that the Fed cut by 50 basis points, and I'll actually zoom in, you can see it jumped up from almost 200 basis points worth of cuts priced in to 141. And so basically, what twos are saying is that over the next 24 months, the Fed expects Fed funds to be taken 140 basis points lower. Basically, the U.S. Treasury market mapping all the yields out on the curve, it is a very good way of it's the market pricing where it thinks policy rates should be over the next 3 6 months, 1 year, 2 years, 3 years, 5 years, 10 years, right? And less used 7 years. It's not a very popular tenor. But another way of looking at it, which is actually a little bit more accurate than two's Fed funds, is looking at overnight index swaps. This is basically a market that banks use in order to get overnight funding needs. If banks need to generate a little bit of capital on their idle cash, they'll go into the overnight index swaps market. If banks need to take out a small loan overnight, they'll go to the overnight index swaps market. And basically, this is a hedging strategy for banks overnight. It's a very deep, very liquid, actively traded market. And we can derive the path for Fed funds from this market much more accurately than we can from the US Treasury market, or more so, much more real time, if you will. And so you'll see by July of next year, so 10 months from now, the market expects that the delta, so the implied rate change by that point, will be 184 basis points lower. So anywhere between 1.75 and 200 basis point, 2% fully lower than where we are now, which means an implied policy rate of 3%. So essentially, you have two different schools of thought, right? It's one is over the next like 10 months, you'll see the Fed take Fed funds 200 basis points lower. The other is saying, okay, it'll happen over the next 2 years. But essentially, both are correct, right? The policy rate's coming down. The neutral rate is going to be lower. This is very good for net liquidity. At banks, they will have a higher proclivity to lend and lend to more and more and more people instead of just sitting in idle cash, and then collecting, however much, a cool 4%, 4.5%, 5%, on annualized on cash sitting, in the overnight index swap market overnight, or parking it in bills. So that's going to have a really positive impact on net liquidity, because banks will be less incentivized to do things like take their cash, sit in bills, and they'll be more incentivized to move out on the risk curve, do more lending to more types of people, which will be great for overall net liquidity. We're seeing
Mhm.
all central banks in a global rate cutting cycle right now, and the Fed is now moving to it's kind of the last mover here. And so what that's going to do is it's going to drive money kind of out of the idle hands of people who are seeking to capture like 5 to 4.5 to 4% risk free, and move out, and they begin writing more loans, which is excellent for the economy. But this also has the effect of being very good for risk assets. You'll note that there's $6.32 trillion tied up. This is pinned. I'll move this out of the way. $6.32 trillion tied up in money market funds. Basically, they are just sitting there and collecting, whatever the going rate on bills is right now. Bills are 4.7%. Okay. So now that the Fed is cutting rates, basically rates are going to come much further down. Money market funds yielding 4.5% are going to become much less attractive over time. And so now there is $6.32 trillion of capital locked up in money market funds, that chances are it's going to fly elsewhere. It's going to fly into higher yielding risk assets, in the same way that sitting in cash, sitting in treasuries are no longer an attractive option for banks. They're no longer going to be an attractive option for consumers as well. So as the
Mhm.
Fed cuts rates while avoiding recession, obviously you're going to see people buying treasuries, but you're going to see a huge degree of people moving out of treasuries, moving out of money market funds, and moving into higher yielding, riskier investments. Right? We talked about that at the banks, but also for consumers, that means going out and purchasing things like the S&P 500, purchasing things like gold, because now inflation risk is back on the table. You could see the gold popped past brand new all-time highs yesterday, but also things like Bitcoin, right? And so as yields come down, um, capital will shift out of money market funds. The Fed started hiking rates right around here. So I think we probably have close to $2 trillion to come out of these money market funds and into the broader market. Obviously, to be a great deal of that capital to move into traditional risk assets, the S&P 500, the Nasdaq, but a fair bit of it, I think, given the broadening interest in the asset Bitcoin, the fact that it is kind of chopped around here for 6 months and now it's considered a base for Bitcoin's price. I think Bitcoin stands to gain a whole lot as the Fed cuts rates and capital moves out on the risk curve.
Yeah, I agree. And can you flash back to that chart real quick of the money market fund, because this is really interesting to me, because you can see very clearly there in 2020 where it goes up when they expanded the money supply, and then you could see it going down as all that money's piling into risk assets. And something that didn't exist that time around but exists now is these ETFs, right? And so if you're an asset manager, moving money from a money market fund into the spot Bitcoin ETF only takes a few clicks, versus
Hmm.
before you had to actually like take it off that brokerage account, go to a Bitcoin exchange, buy the Bitcoin there. But now with these
Yeah.
ETFs, there's so much less friction. And I definitely agree. I think we're going to see a lot of that capital start to rotate into Bitcoin.
Yeah, I mean, and for a lot of asset managers, they weren't even able to buy Bitcoin. So now that the ETFs are around, and they've been some of the best performing ETFs for the entire year. If you take a look, I can actually pull up an ETF monitor, exchange traded funds, and then I can sort it by year to date flows. And one of the things that you will note is that the Bitcoin ETFs, BlackRock, kind of chief among them, has been the best performing ETF for the entire year. I'll just go and pull up this custom one that I made, and then go over to the flow screen to show this, which indicates a huge amount of institutional interest in Bitcoin. You'll notice I will sort it by year to date flow, and you'll see iShares, right? BlackRock's
Wow.
ETF number 4. You'll see where is Fidelity? Fidelity is somewhere on here. Here we go. Fidelity, number 13, right? So
Mhm.
these are actually a little bit higher. I believe BlackRock's ETF got as high as number 2, and Fidelity's got as high as number 7 or number 8. So these are some of the best performing ETFs of the entire year. Obviously, you have the S&P 500. It's right up there with the S&P 500, Invesco
Yeah.
QQQ, which is very tech heavy. You have basically the U.S. Ag, so all corporate bonds and treasury bonds. You have the total bond market growth, so a more safe play, the Nasdaq again. And then you see IBITS ETF is literally right behind TLT, right, which is the one of the most popular treasury bond ETFs, particularly for people who aren't really as involved in markets. And so very clearly, there's a lot of demand that's going to come on the table for these ETFs. Like you said, it can only happen in a few clicks. This move here was a huge risk off move. We all know what happened during COVID, right? March 2020. We know what happened here. Money market fund assets soared basically $1 trillion in a little bit over a month and a half, a 1.1 trillion. That was a huge risk off move. And then, slowly but surely, as the market started to rally, there was no real material change in money market fund assets. But as rates have come up over this last year, the stock bond correlation has kind of switched up a little bit. Money market fund assets grew, right? So yields fell, right, as bonds were purchased at the same time that the S&P 500 was rallying. And so the stock bond correlation changed. This wasn't these assets didn't increase because of a risk off move. They increased because yields were rising. And now that yields are falling, if we avoid a recession, I believe this is going to come right back down closer to this median level right here as yields become unattractive. Going to move into
Mhm.
things like the S&P 500, into things like gold as inflation risk rises, and of course into our favorite orange coin, Bitcoin.
Incredible. And let's talk about that. You mentioned it twice now, the inflation risk rising, and you tweeted about it the other day. Let me read your tweet verbatim. The upside risks for inflation are back on the menu. So, can you elaborate on this? Because for the past 12 to 18 months, kind of the main theme within markets has been disinflation.
Yeah, so we've had pretty swift and persistent disinflation. I'll actually show on one of my charts here that I've prepared. You could see I have like 600 something charts. But if I go to CPI, I think this will be a good version. Okay, so you can clearly see the disinflation in this chart, which just means slowing inflation, right? Deflation would mean something like this, below zero, so prices are falling. Disinflation just means the rate of price increases is declining. So prices are increasing, but less rapidly. And you'll see we've gone from a zenith of 9.1% to a nadir of 2.5%. We are knocking right up on that upper range of what the Fed considers to be the long run target for CPI. So we've had a huge amount of disinflation. But now what you're seeing is things like gold begin to rally. The reason that inflation risks are kind of back on the menu, I say that because of two things. One thing is TLT it rallied yesterday, and actually the 2-year yield moved a little bit higher toward the end of the day after the Fed's decision. What that tells me is that the market is just outright pricing in that this rate cutting cycle will be less aggressive than anticipated because of strength observed in the labor market. We've seen continuing claims basically flat for 7 to 8 weeks. So it's kind of a contrarian take for me right now to say, hey, look, the labor market isn't going to worsen, isn't going to worsen as badly as a lot of people may think. At least that's what the data is suggesting to me and what the initial market reaction of all these things suggests to me. So the balance of risks for the Fed has been between a deteriorating labor market and price stability. Now that price stability is basically down to where we were, the Fed is cutting rates, in order to make sure that we don't end up with outright deflation. But we're not seeing a slowdown that would really support outright deflation. If you look at continuing claims compared to its 100-day moving average, they've been flat basically since last year. And over the last 7 weeks, they've actually declined. And you'll note that continuing jobless claims basically one for one lead the unemployment rate. This is the unemployment rate lagged by a quarter. And you'll note that basically they lead one another in lockstep. Continuing jobless claims is white. The U3 unemployment rate is in blue. And what do you notice about the what we've seen in jobless claims over the last several weeks, if not months? It's
Yeah, it's
completely
flat.
flat. And so for me, I think now the risks are more so that the Fed may have been too aggressive with his move. Of course, it could have data that we're not seeing, that the labor market could be cooling faster than expected. But now, as the Fed is responding to a labor market that's relatively stable, it's cooling, but it's cooling relatively with some level of stability. Now that it's responding very aggressively with huge rate cuts to that, or at least one huge rate cut to that, the risks are now moving from deflation and a worsening labor market to a growth rebound. And we've seen that with various economic releases over the last few weeks that have been beats, so better than economists have expected. And you only see more beats than misses during economic expansions. Over the last 12, maybe 18 months, you've seen more misses than beats. So we've been in relative economic deceleration. And now you're starting to see at the margin more beats than misses. So what that suggests to me is that now there are risks of a growth rebound. The Fed just cut by 50 basis points into what could possibly be, if the labor market isn't cooling as fast as many are believing it is, into a growth rebound, which means an inflation rebound. And not only did the bond market reaction kind of confirm that yesterday, at least at the end of the day, but the reaction in gold yesterday confirmed that as well. I'll do a intraday price chart of gold, and I'll zoom out to yesterday, Powell's decision. We hit a brand new all-time high after Powell's decision. We came back down, but now we're right back above where we were pre-meeting. So all of this together suggests to me that there is some level of price inflation risk of being priced back into the market. There's some kind of risk of a growth rebound. And so really for me, if we do end up getting a recession within the next 12 months, and we start with a 50 basis point rate cut, equities may end up lower than they were before we started cutting. That's historically what has happened. But because there is no recession yet, and we just lowered rates by 50 basis points, if we can avoid recession, I do think that this aggressive cut, the spurt on risk taking that occurs as a result of it, the increased economic activity in the private sector that occurs as a result of it, I think potentially the Fed may be risking an inflation reacceleration. Now, again, we will need much more data over the next several weeks to confirm that this is anything like a risk. But what I'll be looking out for is these reports about the labor market, whether we're getting more misses than beats or more beats than misses. And that's going to tell me whether or not we are still decelerating and the deceleration is going faster and faster, or if we are risking a growth rebound. And I'll also keep my eye on headline CPI in order to confirm that for myself. But that is just a little bit of speculation. There's some more inflation risk that's kind of back on the table. It's back on the menu. It's being witnessed in the market right now. And we'll see how that plays out over the next several months. But if it doesn't, if we do get swift deterioration in the labor market, the Fed comes in with even further easing, further aggressive cuts, which is basically the reason we started with 50. Bitcoin stands to do well in the long term, right? If we get this kind of proverbial soft landing, maybe we get a little bit more inflation, and the Fed can bring rates down to neutral without igniting a whole lot of price inflation. Bitcoin stands to do even better in the near term. So I don't usually throw out price targets, but I do think Q1 2025 probably right around the time that Bitcoin, blasts through 100K. To take a look back at that Bitcoin chart that I made just for 1 second, it's no coincidence. Day after the Fed meeting, we break above this little resistance that we've had here for quite some time. We've had lower lows since March. And if Bitcoin can get all the way up to 65K, that will be the very first higher high that we've had in 6 months. Okay. So obviously we were making higher highs as we rocketed up to an all-time high. That would be an extreme sign of strength for Bitcoin, a huge sign of life for Bitcoin. For me, it's no coincidence that it came the day after the Fed cut rates by 50 basis points. That is a vote of confidence from the market that this is the way things should be going, that the economy is going to rip roar, that we're going to return back down to a good positive neutral rate. Businesses are going to be, it's going to be easier for them to borrow, going to be easier for consumers to borrow. And it's all risk on from there. So big old ramble, but I think Bitcoin stands to do extremely well as a result of what the Fed did if we can avoid recession.
Incredible. I think that 65K level is right around where the short-term holder cost basis is at too. So I've got my eye on that. I think if we get through there, it's going to be looking pretty bright for the next couple months for Bitcoin. It was really well articulated data back thesis on why inflation, we shouldn't, it's not over yet, right? It could very well sort of pick back up. Now, if I may sort of left bell curve approach this, we've seen the labor market hasn't broken like we thought it would. Risk assets have done really well. Is this all as simple as just these massive fiscal deficits from the government being net inflationary?
Yeah, I mean, it plays a huge role in it. Let's be real. Like when you are running a 1.1, I think it's like $1.5 trillion annual deficit right now. A deficit that is 5 to 6% of GDP. Yeah, you're spending more money than into the economy than there is in existence, and we're actually producing. More units of debt are required to maintain the same level of economic growth. And the only way to get out of that is a multi-year period of austerity where we just stop spending as much as we are. We let the economy reset. But that would involve a recession like we've never seen before since the Great Depression. So there's really no way out of this necessarily, other than continually, basically persistent and structural deficits, just to make sure we don't plunge ourselves into a huge multi-year period of joblessness and despair. So yeah, it is kind of as simple as the U.S. government is running these huge deficits. It's spending all this money into existence. We are spending more than we are actually producing as a country in order to support the country. So yeah, no, frankly, it is as simple as these deficits are huge. They can't go away unless we want to enter into a huge multi-year recession. And as a result, asset prices stand to appreciate in a huge outsized manner relative to people who don't own assets, right? The asset owners will continue getting very, very wealthy. Those who are asset poor will not be. We may have more persistent inflation as a result of all of this. And so really, there's never been a better time from a federal debt standpoint to allocate to Bitcoin. BlackRock actually said this in a report about Bitcoin that was released yesterday. I tweeted out that BlackRock said this. Basically, they said the growing concerns in the U.S. and abroad over the state of U.S. federal deficits and debt has increased the appeal of potential alternative reserve assets as a potential hedge against possible future events affecting the U.S. dollar. This dynamic appears to be also taking hold in other countries where debt accumulation has been significant. In our experience with clients to date, this explains a substantial portion of the recent broadening institutional interest in Bitcoin. So BlackRock is saying accelerating U.S. debt growth and accelerating U.S. deficit growth is a huge reason why people are jumping ship to alternative reserve assets from things like the dollar and U.S. Treasuries into Bitcoin. Now, does that mean the dollar is going to die tomorrow? No, we're still the king of global fiat. Does that mean U.S. Treasuries are going to stop being the world's preferred collateral? No, definitely not anytime soon. But it does mean that at the margin, institutional investors, huge banks are seeing that this is a big issue. And now that they have the ability to allocate to things like Bitcoin and alternative assets, they're choosing to do so. BlackRock, world's largest asset manager, doesn't lie. And it literally said in its report that a lot of the reason behind the institutional interest in Bitcoin is because of the issue of deficits. So if we're just left curving it, yeah, as long as the US government spends more than the economy writ large creates, is producing, right? As long as the growth of the economy is reliant on more and more and more increasing marginal debt issuance, then yeah, it's basically buy and hold hard assets until the cows come home. And the hardest asset of all is Bitcoin.
Very well said. And BlackRock, they get it. I mean, the thesis really is that simple. I hold Bitcoin because I tend to believe governments would rather devalue the currency, pump up asset prices, and continue to expand the debt versus become financially responsible, have this nasty sort of Great Depression, Great Recession, contraction of credit. So, and massive unemployment. I don't think they want that. I think they would rather continue to have the asset owners get wealthy. So I myself want to be an asset owner in that scenario. And I got a few more questions, really more focused on Bitcoin now. What are your thoughts on this idea of Bitcoin per share as kind of being the new standard by which companies are valued?
Absolutely. So I've been doing a lot of writing on this recently. I just had Sam Callahan on the Theya podcast, which can be found at, if you just search Theya Bitcoin on YouTube, you'll be able to find it. Sam Callahan went on a great discussion about Bitcoin per share. So essentially, it's this new financial metric that has emerged because more companies are adopting Bitcoin into their treasury reserve. And a lot of shareholder demand is coming from wanting companies to hold Bitcoin per share. And so basically over the last couple of days, actually, you've seen companies like Cathedra Bitcoin, a company that is a US based company that trades on the Canadian TSX Venture Exchange, has announced that it is completely reworking its operations away from Bitcoin mining and into data center creation and operation, which is a better, a more reliable business from a cash flow perspective. In order to increase its Bitcoin per share, it's basically reworking its whole business model just to maximize BPS. And so it's this brand new emerging financial metric that I think will get more popular over the next several years and decades as more businesses take Bitcoin into reserve and as investors are demanding more Bitcoin derivatives. So we've seen the extreme success of MicroStrategy. Not only has Bitcoin been great for their balance sheet, and a company that was previously kind of teetering and it was struggling quite a bit, it has breathed new life into them from a culture perspective and from a relevance perspective, but also from an investor perspective. Their share price is more than 10x as a result of adopting Bitcoin into their reserve. And so now they've formally integrated Bitcoin per share into the way that they report their financial metrics, right up there alongside earnings per share. And in the same way, now you've seen Cathedra Bitcoin make the exact same move, wholesale change its business model, take Bitcoin into its treasury, and then prioritize maximizing Bitcoin per share for shareholders. As Bitcoin grows in price, as institutional interest in Bitcoin grows, and more people are looking for derivatives that they can put in their portfolio alongside Bitcoin in small allocations, Bitcoin per share is going to become an even more popular metric for individuals to gauge the health of companies. Metaplanet has gone and done the same thing, Japanese publicly traded company. So I think it's just going to grow more popular. And it's going to drive more companies as it becomes a more popular financial metric that investors are um, kind of trading based off of and purchasing equities based on, and purchasing debt from those companies based on. I think it's going to drive more businesses to take Bitcoin into reserve. And so I think it is an excellent development, and I love seeing it formalized.
Yeah, I love it too. And it's the only thing that really gets me excited about any equity, right? Because Bitcoin, once you understand it, that is the opportunity cost for any decision when it comes to allocating capital. And so if a stock or a public company, if their stated goal is anything other than we're going to try to accumulate as much Bitcoin as we can on your behalf, then I have no interest in it. And so to be honest, like I run pretty much a barbell portfolio with my small net worth, and the things that aren't spot Bitcoin, they're Bitcoin exposed equities, right? It's your things like MicroStrategy, Metaplanet, and now Cathedra. They're getting into it as well. So I love to see it, and any company that has access to these public markets, they need to be leveraging it as best they can, right? Because regular guys like you and me, we can't just go and issue convertible notes and borrow for really long payback periods with low interest rates the same way these public companies can. So it really creates an interesting opportunity to get some sort of more safe leverage Bitcoin exposure, I would say. And on this idea of growing Bitcoin per share, there was a bit of a tense back and forth recently between Michael Saylor and Saifedean on this idea of like getting yield on your Bitcoin. And Saylor seems to believe that it's possible in a world for Bitcoin banks to exist that lend only to creditworthy borrowers and in an over collateralized way, which he says could provide bank depositors with quote unquote risk-free yield on Bitcoin. What are your thoughts on this? And did you listen to this conversation between Safe and Michael Saylor?
So I didn't listen to the conversation, but I've heard that there's a lot of hullabaloo surrounding it. So I think I'll have to check it out. But per the first kind of statement about Bitcoin banks lending in a over collateralized loans to debtors who have a great deal of Bitcoin and they use Bitcoin as their collateral. That's the future of credit markets. I think that's the future of what credit markets are going to look like, rather than under collateralized loans, rather than students being able to take out $125,000 in student debt over 4 years in a completely under collateralized fashion. I think that you're going to start to see over collateralized lending be the way. Low LTV ratios begin to be the way. And then as a result of that, you have much more stable credit markets. So I do think that Bitcoin is going to become a more popular collateral at banks once banks have the ability to accept it as collateral and hold it themselves. And I think it's going to introduce a great deal of stability to credit markets. It's going to increase the liquidity of Bitcoin because it's a very attractive form of collateral for banks because it can be liquidated 24/7, 365. And so, I think lending over collateralized to individuals who post Bitcoin as collateral, and then having the with a low LTV ratio, obviously, and then being able to liquidate it 24/7, 365. It's kind of a pristine collateral for banks and financial institutions to use when they're extending loans. So I think that that certainly is the future of credit markets. It's going to become a very, very popular collateral for banks once they have the ability to use it. I think risk free is not used correctly in that conversation. I think Michael Saylor, very brilliant man, but I don't think necessarily risk free, because that's kind of a misnomer. The only reason that U.S. Treasury debt is considered risk free is because it can print the difference. If it doesn't generate enough revenue, it can tax its citizens into perpetuity with impunity, and it can also print the difference. And so that's the only reason it's risk free. You can't create more Bitcoin. In case anything goes south with Bitcoin's price, or in case anything goes south from a lending perspective. So it's not risk free. But I do think that generating yield on your Bitcoin in an over collateralized, with loans that have low LTV using Bitcoin as collateral, I think that is a fair idea. As it pertains to MicroStrategy's balance sheet in their 8K, they've started using a new key performance indicator that they created called Bitcoin Yield. Basically, all it is, they use the word yield not in the sense of like the sense of, oh, we're taking the Bitcoin that we own and then we're going and we're levering up against it. Bitcoin yield is basically a way for MicroStrategy to showcase to investors the percentage of the stock's performance over a given period that has been attributed to their acquisition and
Mm,
holding of Bitcoin. So it's just a way for investors to see how much of MicroStrategy's stock price performance has to do with the Bitcoin they hold. So I think it's a useful tool for investors, that KPI that they have created, Bitcoin yield. I think it's 4% quarter to date of their MicroStrategy stock performance has been attributed to the Bitcoin they own. 17% of MicroStrategy stock performance since the beginning of the year has had to do with the Bitcoin they own. So it's helpful for investors in the same way that Bitcoin per share is helpful for investors to see how much Bitcoin a company owns, and Bitcoin yield is a helpful way of showing investors what percentage of their equity price performance is due to the Bitcoin they hold. So it's just demonstrating the utility of holding Bitcoin to active investors and would-be investors into that stock. But I think using the other part is a separate conversation. I don't think using the term risk-free is a very good way of describing what over-collateralized Bitcoin lending actually is and offers.
gotcha. That was well said. And I tend to agree. I don't think Bitcoin is going to get rid of all lending, period, like some Bitcoiners believe. It's just going to make it very, very different, right? Because when you can't expand the money supply and the actual increase in technology and productivity in humanity goes into the money, just getting a 0% nominal return is like getting a positive real return. So to actually get any amount of a nominal return is going to be good. So I think you're just gonna it's gonna play very differently. But Bitcoin is too good as collateral, like you mentioned. The ability to verify holdings, have collaborative holdings, and then it treats 24/7, 365. It's too good of collateral to not be used in some capacity for borrowing and lending. So I think we'll definitely it's going to be interesting to see how that kind of market develops over the next few decades. I think it'll certainly change and evolve, and it'll be interesting. We live in an amazing time. Joe, I really appreciate you taking the time to come on the show. Where can we send the audience to keep up with what you're doing?
Absolutely. You can find me on X at Joe Consorti, the same way it's spelled on screen in the title or in the description. And you can also visit Theya.us. I know that we've been working with you guys for a little while over at Blockware, but Theya is the world's simplest Bitcoin self custody solution, the best place to buy and store your Bitcoin for the long run. Obviously, with Blockware, you can deploy capital into miners and actively earn Bitcoin. But with Theya, we offer the best way that people can store that Bitcoin that they do earn with Blockware if you already are a Blockware customer. So go to Theya.us, check it out, download it on your iPhone for free, Android version coming soon. And if you'd like to book a consultation call to talk all things self custody and what solution might be right for you, you could do so from the Theya.us homepage. You could speak directly to me or one of our other founders.
Awesome. Hold your Bitcoin with Thea and mine it with Blockware. Thank you, Joe. Appreciate it.
Thanks, Mitch.